Now, there is an interesting argument and article here between proof of work and proof of stake for investors. Now, we've been trying to get I have been trying to get a better idea of like how investors see things, because it's really interesting as they seem to have, first of all, an even lower level of knowledge surrounding blockchain than the average miner, for example. So they don't understand all of the intricacies surrounding it for the most part, but they do have the most capital, right? And their participation matters a lot. So understanding their point of view, I think, is extremely important. Now, this is an opinion piece from CoinDesk. And it says, if you know anything about crypto and also read the news, I'm sure you've read about crypto mining. And if you've read about crypto mining, you've read about how Bitcoin depends on proof of work, which is so terrible for the environment, and about how Ethereum is moving from proof of work to proof of stake soon, which is so much better for the environment. Which is better? In answering that, most proof of work versus proof of stake pieces either get too technical or are too obviously biased. From an investor perspective, you just want the facts and the trade-off so that you can make an investment decision. And see, I feel like as an investor, you would want to actually understand it from a technical perspective, but I do get it, right? I mean, much of this world and the even in the stock markets and so on, has a lot less to do with what's technically going on and more about how investors feel surrounding some sort of project or entity or company or whatever it may be. I'm not, in blockchain, I think it does get down to needing to have a little bit more of a technical perspective surrounding this. So I disagree a little bit, but once again, I'm doing this to get the investors' perspective. So their perspective is, just a top-down, high-level trade-off of it. So herein lies the investor's definitive guide to proof of work and proof of stake. An actual book could be written about this. So a lot of the technical nuances will be papered over to avoid word count creep. But first, a quick detour that I promise is relevant. This might surprise you, but investing in software engineering aren't too different. Fundamentally, investing is about trade-offs, so is software engineering. In investing, you have a certain amount of capital and you allocate that certain amount of capital in a certain way. When you choose to invest in thing one, you can't also invest in that same capital into thing two. And in choosing to allocate to thing one over thing two, the allocator takes several things into account, like expected return, risk profile, or if investing in thing two would be a cause for termination because the boss doesn't like thing two for whatever reason. In software engineering, you have a product that has a particular behavior and structure. An engineer will design something that behaves a certain way and will make structural decisions for the code. These structural decisions determine how easy it would be to make adjustments down the road. Cryptocurrencies aim to operate their networks without the extensive use of third parties. To do that, network participants need a way to decide on what's what and come to a consensus. Enter the consensus mechanisms. There are many consensus mechanisms, but the two most important ones are proof of work and proof of stake. Between the two, there are trade-offs, but the most critical thing to know about consensus mechanisms is that they need resilience to ward off attackers of the network. So let's take a piecemeal approach of the investor's guide by first defending proof of work in the context of Bitcoin, and second, defending proof of stake in the context of Ethereum, and third, outlining some of the trade-offs. In defense of proof of work, there are so many awful comparisons people use to describe proof of work. Here's one. There's a lottery. To win the lottery, you need to buy the winning lottery ticket. To buy a lottery ticket, you need a computer that can do lottery ticket buying. The more computers you have, the more lottery tickets you can buy. And if your lottery ticket matches the winning number, you win. So the more computers you have, the more likely you are to win the lottery. Now, he says this is a bad definition, but this is exactly what Chia is, by the way, because what Chia is that you are basically printing bingo cards onto your hard drives in hopes that you print the winning bingo card. So in some cases, and now, yes, as far as a consensus mechanism, it's proof of storage, essentially, and there is that. But the trade-off with that, too, is that in a time when we are so dependent on big data and data is so important and the rising need for it, taking essentially hard drives and using them for a meaningless purpose, such as printing random bingo cards on them to win a block, doesn't seem the best move or necessarily green, in my opinion. All right, so that aside though, in Bitcoin, which uses proof of work, miners, as the proof of work lottery ticket buyers are called, use application-specific computers to guess the number on the winning lottery ticket. Those computers have microchips that can do guessing and run on electricity. The only way to get the right number is to do the work. Proof of work has distinctive advantages and disadvantages. Proof of work is a resilient way to build distributed consensus and deter spam. Proof of work has been used in Bitcoin since it launched in 2009 to trustlessly run a decentralized, borderless, open payment network. Bitcoin's proof of work mechanism worked just as well when a Bitcoin was worth 6 cents as it did when it was worth $60,000. Bottom line, proof of work works, and it works really well. That said, proof of work consensus mechanisms are hardware intensive and rely on high demand microprocessors. As a result, investing in proof of work can take time if there are supply chain disruptions, as we've seen recently. Due to the need for consistent electricity and warehouse space, there are centralizing geographic choke points where mining tends to coalesce in places with adequate space and cheap electricity. So while miners may be distributed across the machines, they could all end up setting up shop in, say, the Chinese province of Sichuan. Proof of work does have a double-edged sword. Depending on your specific framework, it uses electricity. I'm not going to argue about whether Bitcoin is valiant use of electricity or is utilizing the right kind of electricity, but it certainly uses it. Yes, proof of work could monetize otherwise wasted electricity, stabilize power grids, and boost local economies, but Bitcoin mining has revitalized some otherwise obsolete fossil fuel electricity generation plants as well. This isn't in defense. It feels like, and this will be interesting to see how they write, but this is already feeling biased against it because this was supposed to be in defense of proof of work, and they're very poor arguments that actually go against proof of work for the most part. They kind of reiterate some of the points, though, that we make, like stabilizing power grids and, reducing waste of electricity, that sort of thing. But that was very odd. So in defense of proof of stake, there are some awful comparisons people use to describe proof of stake. Here's one of mine. There's a lottery, and to win the lottery, you need to purchase a lottery ticket. To be allowed to buy a lottery ticket, you must be chosen. To be chosen, you need to commit money to the lottery. The more money you commit, the more likely you are to be chosen. If you're chosen to buy a ticket, your ticket will automatically match the winning number and you win. So the more money you have committed, the more likely you are to win the lottery. In Ethereum, which will eventually use proof of stake, validators, as the proof of stake lottery ticket buyers are called, are chosen randomly to win lottery based on the amount of capital they have staked. The way to get chosen more often is to stake more capital. Yes, the way to get chosen more often is to stake more capital. There are ways in proof of work that do increase your odds. I'm not sure outside of the lottery ticket description that they're using here, such as reducing latency, increasing, network performance, all that sort of stuff, building out your own node infrastructure and so on. I'm not so sure that there is a way to do that with proof of stake necessarily. But I guess technically with Ethereum, building the consensus and execution layers on the same machine, or at least within the same network, could probably provide some advantages there. Proof of stake has advantages and disadvantages. It is an effective means to build distributed consensus. While nothing is battle tested as proof of work, there are cryptocurrencies that have been using proof of stake successfully for years. In the world of Ethereum specifically, it is very expensive to become a validator. And here's the thing about this first one, right? There are, cryptocurrencies that have been using proof of stake for years. That is true, but not to the level of use that Ethereum has had, right? And so this will be kind of where the rubber meets the road when we talk about proof of stake versus proof of work, because the rubber is about to meet the road and all of the use cases that Ethereum has and the amount of transactions that are on it will be the first time we see something like this to this scale on proof of stake. So that's going to be a big question. In the world of Ethereum specifically, it is very expensive to become a validator. To become a validator and participate in the lottery, you need to commit 32 ETH, about $60,000. Granted, there is a mechanism in which you could commit less ETH to a pool of capital that is then staked, but that isn't the same thing. The high starting cost could result in a rich blockchain with only wealthy capital holders participating and validating. Interesting. He keeps saying, here's in defense of, and then really it's flipped. This is a good argument, against a proof of stake, essentially. Proof of stake does have a double-edged sword, depending on your specific framework. It uses capital. In a way, this is advantageous because anyone, anywhere, with enough money can become a validator. There isn't the same geographical centralization risk as there is with proof of work. Okay, although there may be one given wealth inequality across the globe. That said, because proof of stake only requires capital, the barrier to entry can be lower. It doesn't require just capital, though. And that's like the confusing part that I think a lot of people run into. So from the infrastructure standpoint, it does require basically a PC, a virtual machine in most cases, usually run in on a virtual private server. And we'll talk about the centralization risks there geographically as well. But it requires that. And it not only does it require it, but it requires it to run 24/7. With backups, which means that you need to have basically three pieces, right? You're going to have a backup server, a server running the backup server running the main thing, and then some sort of failover server sitting there to take it over whenever it fails over, if the initial server fails over. So you basically have three different pieces. It'd be like if you had to try to set up redundancy for proof of work, which is technically impossible and one of the big problems with hosting GPUs, or GPU mining, by the way. But there is all of that problem. And where are we seeing a majority of the validator nodes being built? Well, we're seeing being built in AWS, which is controlled by Amazon. So now not only do you have a potential geographical restriction, not as much with somebody as large as AWS, right? But you have a corporation centralization issue, right? Where basically all of the power everything to power the blockchain and provide consensus is all being run by a single entity. Sure, maybe not completely like geographical restrictions, but essentially a single entity, a single company. It's corporatized, right? And at any point, like we've seen with centralized, data centers and so on, they could decide that they don't want that sort of thing on their network and just take it off. Case in point would be something like Parler, where they didn't agree with Parler or what it was doing, so they just took it down themselves, right? And this is something that could be done and could be a huge risk to proof of stake coins. If we merge, for example, on Ethereum, and the proof of stake is going good, but then the SEC decides, for example, that it's a security, and then they want to find an avenue to shut it down, well, they could just basically petition AWS and Google and Microsoft to stop all services for blockchain, specifically Ethereum, if they wanted to. And then at that point, you lose all of those nodes. If those nodes don't have their keys backed up, then dear Lord, I cry for them, but hopefully they do and they can spin them up. But that means that they all need to start spinning up, well, their own server infrastructure. And to be frank, it's a lot easier for me to teach you guys essentially, and I can teach you guys server infrastructure too. In fact, I have a lot of plans to do that, but it's a lot easier to teach someone to build a mining rig or mine from their gaming PC than it is to teach them to build up server infrastructure with high availability, failover, basically multiple internet connections. So you have internet connection failovers and all of that, battery backups and so on. And if you do get to a point to where, all of these big and rich investors, this rich blockchain just gets shut off of AWS, more than likely, they're probably just going to dump the ETH at that point, recover their wallet and get rid of it. I just don't think that that it is necessarily true that you have a more decentralized coin at the end of the day. And that's the reason why. As mentioned earlier, this could take up an entire book. The following trade-offs between proof of stake and proof of work are not exhaustive. It is easier to attack proof of stake network because proof of work is more resilient. Stealing some thoughts from Andreas Antonopoulos, all it takes to attack a proof of work network is electricity and hardware brought together at the right time, at the right place, with the right incentives. And logistically, this is becoming harder and harder to pull off. However, with this kind of move off of Ethereum from proof of work to proof of stake, I think we will see this threat come to fruition. And that's because a lot of the other networks are significantly smaller that remain proof of work for GPU mining. And a majority of, the GPU hash rate is currently on Ethereum, meaning that what you could end up in a position of is that all the miners move to NiceHash, which then just basically opens up an attack vector on every single small cap proof of work GPU mineable coin in existence. And this could be really, really bad unless they have solved these things in the past. Now, kudos to Ethereum Classic because they were attacked a ton because it was the easiest one to attack because of how close it is in comparison to Ethereum, that they started putting in, basically work into preventing this. So they probably have a pretty good standing against it. Plus all of the investment from Bitmain means that they will have all of the ASICs to help secure the network. Ethereum Classic is going to probably be good from the security standpoint. The rest of them, not so much though, when this starts to happen. With proof of stake, all it takes is money. To the credit of Ethereum, under proof of stake, it will still take a lot of money to attract or attack the network, but it requires less coordination. That said, proof of stake is theoretically more accessible because it only requires capital. Once again, it doesn't, okay? But that's okay. Granted, it can be a lot if you're looking at Ethereum around $60,000, but the coordination mentioned in the previous paragraph can be a barrier to entry that doesn't exist in proof of stake. In a similar vein, proof of stake is more mobile than proof of work. Given the electricity draw needed for proof of work, a government can figure out where miners are operating and shut down individual locations. However, this isn't as big of a problem if we look at something like Monero. So once again, it depends on the scale and the incentive. Like right now, because proof of work, you're incentivized to build a bunch more rigs and so on. That does mean you do get a concentration of power on the network. Now, governments can shut them down, but then I think Bitcoin's fine because you just end up having you have an auto-adjusted difficulty that takes into account that problem. Moving a proof of work operation that's been shut down to a new location takes a lot of work. We saw this happen when China banned Bitcoin mining last year, which led to a drop in network activity that eventually recovered, although it took some time. It really didn't take much time. What was it, 20%, 20 to 30%, and then it recovered within about a month to 3 months? Moving a proof of stake operation would be trivial in comparison. Now, I do think that is true. Last one I'll touch on, but not expand on because I don't truly believe it should matter, is that proof of stake doesn't use electricity and proof of work does. So if you're a single issue investor, investment in proof of work might not even be a consideration for you. There are merits to proof of work, and I have spent years defending Bitcoin mining privately and professionally, but in the end, I'm not here to tell you how to think or what to do. Now, that statement's interesting because there is the narrative that it uses, doesn't use electricity, but it does use electricity, right? And it does create more processing waste in general, once again, because of your incentive to basically have backups and failovers in place, meaning you just have additional power to run that node that is not doing anything. Still going to be less than mining, right? But you do have some electricity that goes into it. So that pretty much covers their opinion from the investor standpoint. It seems like obviously the big one is the power thing. And then from there, it's the barrier to entry. And I do think that from the investment standpoint, that is the biggest issue. It is the barrier to entry. A barrier to entry to actually run a full stake of Ethereum that you control the keys to is going to be around $60,000 as of right now. Whereas with mining, you could buy a GPU as cheap as $150 and start to basically generate some revenue. So that does mean from an investment standpoint, I think proof of work versus proof of stake is better, but also the investors are looking at just buying the coin, not necessarily doing the validation, whether that be proof of work or proof of stake. So then you come down to basically what they think looks more appealing. And the narrative that, proof of stake is more green is a very strong narrative that I think influences a lot of retail investors. And that is proving out to be true as we start to see, of course, the price of Ethereum continue to go up with reports of its move to proof of stake and the merge coming in September. Thanks for checking out this clip from the Crypto Mining Show. You can check out the full episode here or more crypto content down here. Also, I'd like you to check out my locals page at sonofatech.locals.com, where you can become a member for free or choose to be a $5 a month supporter that unlocks additional content.